Hey, everybody, welcome to my live stream. It is Tuesday, January 21st, and it is 7:30 p.m. Eastern Standard Time. The market has closed. We had a very good day on Wall Street today with the market going up nicely across the board. The star of the show today was the Russell 2000, where we had small caps really working today. They went up 1.85%. Really good day for small caps. The Dow, which is a lot of industrial stocks in here, we'll take a closer look in a little bit. They were up 1.24%. Real nice. And the S&P did well, and so the Nasdaq had a decent day as well. So it was a really good initial day of the week and a continuation of the market this past week. So it's pretty rosy from my perspective. It's nice to see that the market is really going up in value. That's always welcomed for stocks to go up. Some big news. Obviously, the president took office, and this is the new president's first day on the job. And he had a lot of executive orders, a lot of them affecting different parts of our government. And he also introduced that the SEC would start working on establishing rules for cryptocurrencies. And I think that's really welcomed because cryptocurrencies have become a substantial alternative asset class. And it would be good for the government to start to work with cryptocurrencies and companies that are working within cryptocurrencies so that there could be rules for the particular asset class. And I think it'll bring confidence. It'll bring the proper way of reporting your cryptocurrencies and gains and so forth. I think the government really stands to benefit from it. We want to keep cryptocurrencies domestic so that all the new innovations and developments within cryptocurrencies stay here in the US. We don't want another country to become the leader in crypto. We want crypto to be here in the US. That was welcome news. Interest rates dropped a little bit, which was really nice to see. And the drop in rates will cause bonds to rise, which is good for bondholders. It was also really good for those small caps, as you saw. So Bitcoin went up to as high as 109,000 per coin. Right now, it's operating a little under $106,000 per coin. That's a really nice level for Bitcoin. It's really gone up a lot. In 1 year, it's up 167%. The Bitcoin that's a great rate of return. And I've been dollar cost averaging and trying to buy along, pullbacks. The most recent pullback I bought into Bitcoin last week, so I'm glad I did so because those fractions of a Bitcoin that I bought are worth more now. So good stuff happening in crypto. So looking at different sectors, what sectors are working out there? The number one sector today was industrials. That's good to see because industrials are kind of like the blue collar jobs, the companies that have been around for a long time. So it's good to see those industries do well. And for the day, they did well. Year to date, they're doing well, up 6.43%. Healthcare had a good day, and healthcare is up 3%. Utilities just keep doing well. Utilities have been really doing great over the last 2 years or so. So go utilities. Real estate had a good day, but real estate's really had a tough time with these higher interest rates. Materials was there. And then toward the bottom of the stack, looks like energy just barely pulled off a small gain. Consumer staples, And then technology was okay, but it didn't lead. It kind of lagged the other sectors. So that's interesting. Now let's look at the major caps, because there was a change in the most valuable company on the exchange was Apple as of Friday. But today, Apple stock went down 3%. Meanwhile, NVIDIA stock went up 2%. So now NVIDIA is the most valuable company on the stock market. And Microsoft's sitting here in third place. And I guess this is the podium: the gold medalist, the silver medalist, and the bronze medalist. But all kidding aside, Apple has officially gone into correction territory for the year. Year to date, it's down more than 12%. What is going on in Apple? And as I've noted on my channel for well over a year, my doubts around Apple, they've been there. I'm not impressed with the revenue growth. I'm not impressed with a lot of things. And I think they were resting on their laurels, or resting on that iPhone. And I get that the iPhone is great. It's great business, but you got to keep growing. If you don't grow, you're going to get passed up. So we'll see what happens with Apple. I don't think they're out of the woods, and they're going to announce next week. If they have an announcement and they really guide down, it'll be interesting to see what happens. Will the stock drop 10%, 20%? I don't know. But that was a big loser of the day. Apple going down 3% on a $3.4 trillion valuation. That's like $100 billion of market cap going away. Those are the level of outflows that are going away from Apple. I don't think they're going to come back. Microsoft is pretty steady. I'm buying into Microsoft. Amazon up nicely. I own Amazon. We'll buy more shares on pullbacks. I own lots of Google, Alphabet. They did okay. Meta, that's my number one holding. It's doing okay. I had an okay day. Tesla was down a little bit. But year to date, all these, I think, are doing fine. TSM's really doing well, almost 11% year to date. So that's what's happening with the big caps. When we look at earnings, so Netflix announced after the market closed, and they had a phenomenal earnings report. We can talk about it. In fact, we should talk about it in a few, as well as some others. I saw Prologis was an announcement. That's an interesting one to cover. We should go over it. And we should go over 3M. That's one of the stocks that I own. We'll go over United. That one is a stock that I owned in the past and sold in 2024. It's doing well, continues to go up. And just some good announcements today. Nothing humongous, but pretty big. I mean, you got Netflix in there. So thanks everybody for joining. We are 4 strong on the live stream. Thanks for tuning in. And let me know if you've got something you want to talk about. I'd be happy to respond to your comments, talk through some topics that you want to talk about. All right, so let's start with our friends at Netflix, and let me share with you what I saw, because I read their earnings announcement and I was impressed. I was impressed that they were growing top line revenue by 16%. They grew their user base by 16%. Those are 2 really good numbers. And profitability grew. That was really good. I really am impressed as to how they're getting customers all over the world. And their number one market now, it's not the US, it's EMEA, which is impressive. Now, the one area that didn't look great was free cash flow. Free cash flow was not very good for Netflix. So I happen to think that it's an overpriced stock by 24%. The company is fairly big, but not massive, like, let's say Meta or Apple. Its market cap is $371 billion, soon to be more than that because it's up 14% in the after hours. The market really liked their earnings, and their PE is a little high, 38. Analysts say it's a buy, but you're not getting a discount. I agree with that. And then after today, It's going to be priced at a premium of 14% if you believe these price targets. So in general, this company is doing well. It did the way the numbers they announced were better than the market was expecting. So I expect a lot of these price targets to go up. Earnings per share is one method that I use to value a company, but I also use free cash flow. And in the case of Netflix, they're doing really well. The revenue is going to grow this year by about 12%. Very good. Then 11%, then 9%. They are going to increase the subscription fees on their standard plan, which is going to generate more revenue and profit. So that's the beauty of the subscription business. Earnings per share are going to expand nicely, real nice expansion. So it's going to operate with, PEs they're pretty elevated. It is a big company. It is growing nicely. It is a good business. The one thing that I would say, I was a Netflix stockholder for some time. I bought it at the right time. I sold it at a good time, made good money. And I managed one of my son's portfolios. Netflix is one of the stocks in there. He's held it for a while and he's doing really well with it. And, but I would say that Netflix is kind of a one trick pony. They do streaming. And if they ever falter there, they don't have any other businesses to fall back on. If you think about I would say their primary competitor now, I think, is YouTube. YouTube is the number one streaming platform online. People don't think of it because for the most part, YouTube is free, but there are more people streaming more hours on YouTube than any other platform. In comparison to Netflix, it's number one. Number two is Netflix. And YouTube kind of has the luxury of having Alphabet, a bigger business that has the search business, the Google Cloud business, soon to be robotaxi business, AI business. So there's a variety of businesses that could be working or maybe diversify and keep the company operating during tough times. So that's one thing that I think Netflix doesn't have, that luxury. They're just it's a company that does one thing. They stream. They don't do anything else. So we'll see how that plays out. Now, as we look at a valuation for Netflix. So my valuation, you see that I have a 10% premium on Netflix when I look at their free cash flows and I look at their earnings per share valuation. But once you add that 14% that they're up in the after hours, it's going to be soon to be 24%. So I think they're going to be selling at 24% premium. And I think that I'd rather stay on the sidelines on Netflix. And I sold the stock. I don't regret it. There's other stocks that I do regret selling, but this one I'm okay with. Principally because I own a lot of Google Alphabet. And I think that the Google Alphabet YouTube business, that's the one I want to own. I'm good with that. I also own a lot of Meta. So having too many in the same sector might be a little risky. Who knows? Maybe the government someday says, hey, we're going to limit the eyeballs that watch movies and stuff. And that would be very damaging to Netflix, YouTube, Meta, and so forth. But those are my thoughts on Netflix. I thought they had a superb earnings announcement and the stock was priced for perfection and the company stuck the landing. Very good earnings. Impressive. So that's Netflix. The next company we'll take a look at, let's look at Charles Schwab. And I think most people know what Charles Schwab is about. It's a brokerage. They were up 6%. It's a $148 billion market cap company. And this business was struggling for a while. They've had their struggles, but they're really got it together now. Over the 5-year, you're only doing 67% return with a small dividend. But over the 1 year, it's 27%. That's pretty good. With the dividend, it's a pretty good rate of return. So Charles Schwab had a good day. Brokerages ought to be doing well because the 2024 year was really good for stocks, and that when stocks are doing well, more people come in, they want to invest, they want to be an investor in stocks. So Charles Schwab probably got a lot of customers and are getting a lot of volume so they can make money. And so overall, good company. It's a brokerage. And on their earnings were well received. So their profit beat estimates. Looks good. Let's take a look at how their revenue is doing. So revenue has been going down a little bit. That's a surprise. I mean, the market's doing great. You would think that the revenues would still be going up. And nope, that's not the case. I think they acquired a business back here in 21. It looks like they are not growing currently. That's weird. That is a surprise to me. How come the market loved the numbers so much? Well, it looks like when you look at the quarterly, they are growing. If you look at the quarter. So that looks good after a rough patch. And that's why we saw that chart where the stock price was selling off, is they weren't growing. So yeah, that's a problem. You don't grow, market doesn't like you. Especially during a time when you should be growing. The market for brokerages has been really good. Just look at other stocks that are in that space and they're doing great. Free cash flow is very good. Man, 33 billion. Am I seeing that correctly? 33 billion. That's phenomenal. And they have decent profit margins. They are brokerage, 25%. This number is staggering. Wow. That looks awesome. And then last year's number looked great. How are they getting so much darn cash flow? That's interesting. I think that's worth taking a closer look at. Let's look at their investor homepage and see if I can get a little more detail on that free cash flow number, because I'd like to know what's going on. What is their symbol again? So SCHW. So we'll take a look at their investor page. Now, when I look at numbers that are a little hard to believe, I like looking at the financials because that is the data. So all right, so we've got revenue growth in the fourth quarter of 20%. Looks good. And we've got a lot of commentary. Let me see if I can get to some financials. So here are the revenue. So for the year, see how interest revenue came down, because interest rates have come down if you compare versus a year. And net revenues did go up a little bit. Good. Okay. Charles Schwab is a brokerage, but it looks like they have banking services among other things. Okay. Yeah, they're showing themselves to be more like a bank. See, here are the bank deposits. Having said that, I don't value based on cash flow. I want to look at two things. I want to look at earnings per share, and I want to look at their book value. Make sure they're growing their book value. So book value is growing really well. Well, sort of. Their book value got up to 25, 24, and then it dropped, and now it's back to 20. So it's been a little bit of an up and down chart here. So this one's a little bit of a mixed book value chart. It would have been nice to see it just gradually go up over time and be really impressive. If you look at like New Holdings or Citigroup, they've grown their book value consistently for some time, 7 consecutive years, which is impressive. These guys, they grew it and then they dropped and now they're trying to grow it again. So that one's a little bit spotty. Now, when we look at the forecast, we've got 15 analysts covering Schwab. They say it's a small discount on the stock. There is kind of a disbursement on price targets. Worst case scenario, an analyst thinks it's going to drop to $61 per share. Best case scenario, it's going to go up to 95. As we look at this year, it's expecting that they're going to grow by about 13%. I think that's doable if the market's doing well. And earnings per share is going to expand by 23%. Very good. So that looks really good. Perfect. So Charles Schwab having a good day. I think there's a lot there. Not a lot of consistency, which is a little concerning. And right now I'm good with financial services. I've got a couple banks, one boring bank in Citigroup, and then one exciting bank in New Holdings. I have Robinhood, Coinbase, PayPal. So I'm good with financial services. This one is good for another investor. I'm going to be on the sidelines with regards to Charles Schwab stock, but anybody who owns it, good luck with it. Congratulations on the nice 6% rise. So that is Charles Schwab. Now let's take a look at Prologis, which to me, when you look at a logistics company, it tells you a couple of things. It tells you about that company in particular, but it also tells you about the economy in a way. If logistics companies are really having a lot of success, then that means that a lot of business is being done. So Prologis is up 7%. They announced their earnings before the market opened. It's a really solid gain. For the past year, they're down 8.7%. Interesting. But they just popped on some news. So let's see what some of the headlines are saying. So interesting. Let's see if Stock Analysis has updated. Yeah, they updated their data already. Now, the revenue, I'm looking at the quarterly versus the annual. The annual is showing me that, hey, for the full year 24, revenues dropped by about 1.55, but it's kind of like not giving me enough detail. So I go to the quarterly and I see that in the most recent quarter, they grew by 11%. So the business is actually doing quite well. They had a bad quarter, the quarter that ended June 30th, 2024, which revenues went down 16%. But since then, they've been growing. So the compares are decent, and 11% growth is pretty good for the quarter. I think that's what investors really like, that, hey, these guys have potentially made a turn and are going to be doing well. Let's take a look at other factors like gross margins and free cash flow. So I'm not seeing gross margins in here, but so here's free cash flow margin. Profit margin is 45, but that's the total profit margin. Operating margin at 37%. So this is a logistics company. It's not going to be super high like a software company or pharmaceutical company. That's what I would expect there. All right. So that's what they're doing there. Looking at their cash flow. There's no numbers in cash flow. I guess they haven't released their cash flow statement yet. So we'll have to just work with their earnings per share. Now, 17 analysts cover Prologis, and the worst case scenario is the stock will drop a little bit because the stock is a little beaten down. I showed the chart. It's still negative, even though it went up 7% today. And on average, stock's supposed to rally up to 129, so up 10%. And some analysts are really optimistic that it could go up to $146 per share. That's pretty good. So earnings per share, let's take a look at the revenue growth. Revenue growth is expected in 25 to be 7.44, and the next year at 8%. Then the year after that's going to be even better. So that looks pretty good. Their earnings per share isn't going to be growing. It looks like their costs are going to be up there. So even though their revenue is going up, their profitability is going to be negative for a couple years, and then it'll start to rise again. So their PE is a little high for an industrial like this. I think it's too high. I'd want that to be around 25. This is an industrial stock. These guys are not going to grow and double overnight their top line revenue. And I think that's what's weighing on the stock over the last year, 8.7. It's really tough to compete with these, an industrial stock against, let's say, a technology stock. Technology stocks are just flying, and financial services as well. They're doing really well. So investors sell out of industrial stocks and buy technology, financial services. So their forward P kind of scares me. I would really pump the brakes on this stock. It is a pretty good sized market cap at 110 billion. Then the revenue is $8.2 billion. So Sabir 2, I think it's your first time on a live stream. Thanks for joining and thanks for the comment. Yeah, I can take a look at URI and bear with me. Let me finish my thought on Prologis. So with Prologis, I thought it'd be interesting to look at. It's good to see them grow their revenues. If they consistently grow their revenues, again, it tells me two things. One is this company's doing well, but also the economy is doing well. If companies are shipping products, that means business is being done. That means the economy is in a good place. So if they're growing for a couple quarters, that's a good signal. I'm glad to see that. So that's Prologis. All right, so Sabir 2 wants to take a look at URI. I'm not familiar with that symbol. United Rentals. I haven't looked at this stock in a long time. So United Rentals, through its subsidiaries, operates an equipment and rental company. It operates two segments, general rentals and specialty. So these guys, if there's a lot of construction going on, these guys are going to be busy. If there's a lot of that type of activity where you need heavy equipment, you need to rent it for a month, 6 months, a year, United Rentals is going to do well. Looking at the 1 year chart, it is up 38%. It's up 2% today. They're going to announce earnings next week. That's quite a pop. What happened? It's up 12%. It's a nice little pop there. Now, this company is a $52 billion market cap company. It's $15 billion in revenue. PE is, I think, reasonable at 17. Let's see if they're growing their revenue. So the revenue is growing. That's very good. It is slowing down. Let's look at the quarterly to see where the quarters are lying. 6% growth. I mean, that's pretty decent. I don't know what the state of construction is. I know commercial real estate's been under some stress, like office buildings, but other types of construction have been pretty active. I mean, the whole logistics supply chain space where you have so much product being ordered online, I'm sure that's creating some construction. Data centers have been expanding. You have utilities that are trying to build more power plants. So there is construction out there, and it looks like United Rentals is growing their revenues. So there it is. So we just looked at a logistics company that is beginning to grow. If you look at their quarterly, we're looking at a rentals company that's showing growth. So those are two signals to me that the economy's doing okay. That's probably means that businesses are having revenues and investing, and those are all good things for the economy, in my opinion. All right, so revenue looks good for United Rentals. Over the 5 year, this stock has really worked 400%. Good job, United Rentals. And look at that. This is a pretty smooth chart. Very smooth chart. The PE wasn't too bad. Analysts think it's a buy. It's only discounted a little bit. It was beaten down a bit. I mean, it really dropped. In the month of December, this one dropped quite a bit. And it's regained a lot of that drop. Let's take a look at the forecast here. Looks like 12 analysts cover this stock. And some analysts are optimistic, $963 price target. The worst is $565 on average. This stock's fairly priced, pretty close to its current stock price. It's expected that the revenue is going to grow a little bit, single digit in 25, 26, 27. and their profits are going to expand. Very good. And their PE is going to be nice and low. So this is a nice consistent stock. This has been really getting it done. I think we have a president and administration that's going to be changing some things. So I would think that United Rentals is going to be busy with, for example, I heard that the military is going to be deployed to the border to try to help with illegal people illegally passing the border. Well, I'm sure they're going to need United Rentals to, put more equipment in the field, and they'll have to rent it out from companies like this. That's an example, as well as other things that are going to happen. So I think United Rentals isn't a bad idea. I've never been an investor in United Rentals. I don't really understand construction well enough to really know. I know that construction could be cyclical, and I don't understand it well enough to be able to know when the cycle is in my favor and when it's not. So I've never been in this space, but this one here, this stock has done great. I really, really respect the upward appreciation. And I could see that an investor would like to be in this stock because it's been consistent. It's been a big winner for a while. So I totally get that. The buying was really great at 670, right? I'm Monday morning quarterbacking on that one. But maybe the price for the right investor might still be good. I'm not interested, but that's because I'm not interested in the space. I don't understand it well enough to invest. So that's United Rentals. Thanks for asking, Sabir One. Thanks for tuning in. Carlos Zaragoza, good to see you, man. It's been a while. So I think ETFs are a really good idea. And who are they a good idea for? Well, I was an ETF investor for a long time. And it was during a time when I did not have the time to review companies, keep track of them, and so forth. And it was really like before my kids were born, I invested in, individual stocks. I kind of started a business, started two businesses. I was doing a lot of stuff. And then my kids were born, and it's great to be a dad, and I want to spend a lot of time with them. So my two sons were the priority. When that era of my life came around, I was in a lot of ETFs, mutual funds, and I did okay with that. I needed to be a passive investor. I still owned individual stocks, but I would say a majority of my my brokerage money was in ETFs. Then my kids now are young men, and I have I think more time, and I'm really in a majority of my brokerage balances in individual stocks, some bonds, and some crypto. ETFs are excellent, and they certainly have performed. Just some what I would say about ETFs is try to keep the fees down. A lot of these ETFs are really pegged on an index, so one ETF can't claim to be far better than another. And be aware that some of these high price ETFs, they don't perform very well. So it's double negative. You didn't keep up the market, and then you're paying a lot in fees. I like Vanguard because they keep the fees down. Like I buy a Vanguard ETF for bonds. I have three with Vanguard. One is a short-term bond ETF. One is an intermediate bond ETF, and one is a long-term bond ETF. So I'm still using ETFs. And my wife, she has majority of ETFs and a couple of individual stocks, which is fine. And that's my comment on ETFs, man. Especially if you're thinking, like I had my sister-in-law, she's not a big investor, but I was talking to her this weekend, and I was suggesting to her that, she could get into a nice ETF. She's a retired school teacher. So she has her money in the bank, and she has a pension, and the bank, is paying her on a good day, I don't know, 4 or 5%. And I said, there's nothing wrong with that, but just be aware that you might be able to do better with stocks, and don't put all your money into stocks, but maybe you can put a little portion of that into an ETF and see it grow faster. You'll still have a majority of your money in, these money market accounts that she invests in. So I thought that was a sound suggestion to her. We'll see what she does with that. But that's my comment on ETFs. Not a bad idea. The one thing I would say, if you're a young investor, the one thing that I didn't like about the ETF investing journey is that I didn't learn a lot. I learned that you look at certain ETFs and you invest in them, and it's a little bit of it's super passive. Like, I had no involvement in the stocks they buy or sell. And I really, that's, in most things that I've done that are important to me, I really want to be informed and I want to learn. And for me, individual stocks give me that platform, and I do really well with them. But it does take time and energy, and it takes a real appetite to learn and to make mistakes and to learn from those mistakes, to take the wins and try to learn from those too. Overall, it's really satisfying to find underappreciated stocks, buy them, or stocks that have a bright future, buy them, and then watch those stocks really go up. So, ETFs are good, but I would encourage you to not stop learning. It's one thing if, like when I mentioned, my kids came before everything else. So when my kids were little, I needed to make, spaces in my calendar because my career was really active as well. I just didn't have the time. I wanted to, but what was more important was spending time with my kids. Once the kids got to a certain age, okay, cool, they're good to go. I got back into learning. So don't stop learning. If you have the time, keep learning, and that way you can become better, even better at picking the right ETFs. But hopefully someday you're like really comfortable and there's an industry that you really understand. You can buy individual stocks in that industry because you know it really well. You might be able to pick some really good companies in that industry. So that's something to think about. Robo-managed portfolios. Well, I think that most ETFs are robo-managed. They're following an index. So if they're following like the S&P, they're going to rebalance based on the S&P. And that's what happens. So that's pretty normal. They put either algorithms or some type of bot that's going to rebalance the portfolio over time. They don't do it every day, I don't think. They do it usually every quarter, maybe every month. So keep that in mind. Good questions, guys. And most importantly, like if you're saving and investing, you're way ahead. There was I think kind of making a general statement. Some people feel frustrated that inflation keeps going up, the price of homes keep going up, the price of cars keep going up. Basically what it costs to live comfortably keeps going up. I get that totally. Now, if you're in the investor community, if you are an investor, you are participating in the appreciation of assets. So, for example, if you bought Robinhood and it's screamed up 30% here in 2025, you're feeling pretty good. You're like, the economy's doing well. Whereas if you're not an investor and completely like in money market accounts and you see these prices go up, you get frustrated. You're like, geez, my money isn't going to buy as much as it used to. You are correct. So I think investing is a form of empowering oneself and becoming financially empowered. Like, hey, I'm going to grow my portfolio well past inflation. I'm going to grow my wealth so that it's going to have all the money that I'm going to need at each milestone of my life. My kids want to go to college, no problem. I want to buy a nice house, got it. I want to buy, my family a brand new car, done. All those things get handled if you're part of the investor community. If you're an investor, if you have assets that are going up, whether those assets be real estate, stocks, ETFs, crypto, those things have been performing. I don't need to convince anybody. 2024, 2023, phenomenal appreciation. And really, it's phenomenal growth in wealth. When you look at the NASDAQ over a 5-year period has more than doubled. So if you had ETF that's pegged to the NASDAQ and you put $50,000 into it, 5 years later, you have $100,000. That's liberating. That's empowering. It's like, cool, I got $50,000 more for myself, for my family, for my future. And then you can take what is now 100,000. You started with 50, you added 50, and now you have 100. Well, and keep investing it, turn it into 200 grand and keep doubling it. Next thing you know, you got a couple million. And that becomes really fun. That's being a part of the investor population, the investor that, spends time figuring out how can I grow my wealth, whether my wealth is $5,000 or $500,000 or $5 million. How could I keep growing it, successfully? There was a story that I read a long time ago when I was a youngster. I'm 56. So my youngster days were like I was 20, 25. And it was about this priest, this Catholic priest, and they don't make a lot of money. But when the guy passed, this is like early 90s, he had like $20 million on a priest salary back then, which priests didn't make a lot of money. But the guy was a stock investor, and he compounded his returns, and he doubled his money so many times, he ended up with $20 million. And that money, I think he gave to charity, and priests don't get married, so he didn't have any heirs. But that's a story that I tell my kids, and I kind of find inspiration from. Of course, you can look at like Warren Buffett, who's worth so much money, as another inspiration, but you can get there a variety of ways. You just need to be a part of the investor community. You need to be a part of the investor population. You need to decide, hey, I'm going to be investing to learn and to become better and to double my money. My goal is to double my money every 5 years. If I can do that, I'm good. And it takes a lot of work, learning. But when I accomplish those things, man, it is fun. It is super fun. So good stuff, guys. And one more rule of thumb. When I was a youngster, I was taught that always save more than 10% of your money, minimum 10%. And that was really good advice. Teaches you to live within your means. And I can't say that I haven't had stress around money. I'm a human being, but I can tell you that I've never been short of money. And I grew up in poverty. I didn't grow up with, hey, here's a bunch of money. Don't lose it. No, I grew up in poverty. I kind of got myself through college and built everything that I've been able to have through a lot of breaks, and people helped me along the way. But I really put a lot of effort into it and learned, and was able to do what I do now. And as a young person, for all you young investors, I sought out older community members in my community. We didn't have like Facebook and stuff back then. And I asked them for their advice. Like I had the advice of a real estate developer. He was really kind and generous with his time, and I had advice from another business owner. And that guy told me about the save more than 10% of your money. And he took it from The Richest Man in Babylon, which is a book. That's really sound advice. So if you're young, if you save up your money, you become an investor, pick places where you really know those industries, and you will do really well over time. And more importantly, you'll learn how to invest and how to make money, how to have your money work while you sleep. 24/7, your money's working for you. That way it keeps growing, and you will have down years, but you'll have awesome decades. You'll have a down year here or there. I've survived the dot-com bubble. It's just a blip. The Great Recession, blip number 2. COVID, blip number 3. And my wealth has grown. Over the last 30 years, my wealth has really grown. So keep that in mind. Keep attending live streams, watch videos, invest smartly, kind of try to know what your process is going to be, and then try to learn from each investment you make, each trade you make, and then try to have a little fun with it. All right, so keep the comments coming. All right, so let's keep on this earnings list. So 3M had a good day. I'm a 3M stockholder, and I created a video specific to 3M, and you can watch it on my channel. This stock here, I like investing in companies that are really quality businesses. They've had a turn to the negative. In this case here, 3M had a couple of big lawsuits, class action lawsuits. Those were settled. They were squared away. And then the stock really took off, and I bought at the right time. And the stock's done 36% over the last year. I think it's going to do a lot better than that. It's going to keep going. And the reason for it is 3M has a solid business. It's also an industrial. $80 billion market cap. Revenue is really nice and high at $24.5 billion. PE isn't too bad at 19. And analysts think it's a little pricey, just slightly. They pay a decent dividend. As we look at their revenue growth, and I'm not sure, they divested a business. So what we're seeing here is we're comparing what used to be a bigger business to a smaller business. So these are the negatives. But the market really liked what they had to say. It was up 4%. And they've really repaired their business, and their cash flow is back. Just a lot of things came back together. I was able to kind of research the business, start buying into it. And I'm glad I did so. And I'm sitting on a good gain. I think it's going to keep doing better. I'm going to keep buying shares. This is a good one for me. And I keep saying for me and so forth, just so that everybody understands. Not that I'm trying to be, self-centered, but everything I talk about is just my opinion from my portfolio. I never give out any advice, any financial advice, any recommendations on what stock to buy or hold. If you make your own decisions or go hire a professional to help you with those decisions, I'm just sharing my opinions. That's the only thing I'm expressing when I say that. All right, so we're going to 3M. So 3M, I still think there's a 37% discount. So this thing has nice upside. I think it's going to keep rising because those cash flows. Cash is king. I didn't make that rule, but if you look at really successful investors, most of them will discount the future cash flow of a business. At the end of the day, that is a principle in finance, investing, in life. Something's more valuable if it's going to crank out cash. And this business is going to crank out cash. And that's the cash it's going to crank out. When I discount all those cash flows to today's value, I get $134 billion of value. And I add cash, take away debt. So there's a difference between the value of all those cash flows and its market cap. So that's a 52% difference. There's 52% upside available based on cash flows. Now, on earnings per share, it's fairly priced. It's only off by about 5%. So overall, when I blend the two, and I put more weight in free cash flow, this is 2/3 of the valuation. It's 37% discount. So I think 3M is on the right track. it is headed to the right place. See how it's gone up nicely. I think the economy is going to treat them well. So that's 3M. So Carlos, thanks for tuning in, man. And keep the comments coming, please. All right. So we went over 3M. So United. Now this one is going to be a little bit of medicine that I need to take because I owned United. I made money on United, but I probably sold around here. The reason for it is I expected the airline industry was going to do really well. So I bought into it. Coming off of the COVID years, I just thought these guys were worth a lot more. So I sat on this stock and it just didn't do anything for like 2 years. And finally, I'm like, I can get out. I think I made 25% on my investment. And airlines just are an undesirable industry for a lot of investors. And I got out, and then the stock got in the elevator and went to the top floor because in the 1 year it's up 184%. So I think my logic was correct, but I lost patience with the stock. And again, I gave it like a solid 2 years. It wasn't like I gave it 2 months and then I got out. And the stock's flourishing. So if there's any United stockholders out there, congratulations. You deserve every dime because you probably had to wait, or you were very smart or fortunate and you bought here and you took the elevator ride up. But this business, even though it's up this much, it's still, the forward P is 8.7. Airlines are just like Warren Buffett swore them off. He wouldn't invest in airlines. A lot of people will not invest in airlines. But these guys, for what the revenue they perform at, 56 billion, you're paying a fraction of that for the company. And they're making a lot of money. The earnings per share of $8 per share. So you have like I guess now about a 7% profitability, net income profitability ratio. It's very good. Let's take a look at their free cash flows. They're growing their revenues. Free cash flow, where is that line? Here it is. So free cash flow is not overly awesome. In fact, it's kind of a letdown, frankly. So this might be a good stock to short now. Let's take a look. So free cash flow, look at that, 88. Now these 2 quarters look great, but then 88, what happened there? That is interesting. So I like navigating financials. My education was in accounting way back when, and really like accounting. Great education. Worked in as an accountant for a while, and then I went into the software industry, and that's been awesome. So operating cash flow looks good. It came down a bit because profitability came down. And I don't think this is taking into account the most recent quarter. So that quarter may be really, really good. But that looks good. CapEx. CapEx is, I don't like CapEx. It's a necessity in industries like airlines. And this is one of the things I don't like about airlines. These guys are doing great, but this might be a interesting stock to short. Short percentage, 6%. So not the only one thinking that. So let me make myself a note. And I know United because I held their stock for 2+ years, really analyzed the company for some time. And maybe it is an idea. So that's United Airlines. Next time you take a flight, you're helping them. And some airlines are not doing well. There's some bankruptcies out there like Spirit. And this is a tough business. You got to put so much money into the business, aircraft, maintenance, all that stuff. So this is a little too good to be true. I don't like their cash. Their earnings per share might show. And you see there's a wide dispersion. The biggest bear is saying this stock is way overpriced. The biggest bull is like there's still more upside. But overall, on average, they say The stock's overpriced by 7%. Interesting. They're supposed to keep growing a bit and expanding their profit. So it looks good. Congratulations to all United stockholders. Just be aware, it seems like it's overpriced to the point where I think it might be a pretty good short opportunity. I'm going to take a look at it. All right, everybody. Well, I'm going to keep it a little short and sweet today. We're 11 strong. Thanks so much for tuning in. I need to run and do something with my wife this evening. I thought I was going to be able to stream a little longer, but I need to go take care of something. I got 5 more minutes to go. Michael Anthony, what's up, man? It's good to see you again. NBIS. So NBIS operates as a technology company that engages in building full stack infrastructure to service the global AI industry. Its businesses include Nebius, an AI-centric cloud platform built for intensive AI workloads. Nebius builds full stack infrastructure for AI, including large-scale GPU clusters, cloud platforms, and tools and services for developers. All right. Wow. Look at that. Did these guys just go public? Wow, look at that. What is this range here? So that's kind of a funky chart. So let me go to the different charting tool here. So 5-year. Did these guys just IPO? Yeah, it looks like they just IPO'd. All right. So these guys are in the right place, but so this is up 88%. They IPO'd in October 21st last year. Okay. Okay, so let's take a look at them. So market cap 8.85 billion, revenue about the same. That's pretty impressive. They are losing some money. We'll take a look at their cash flow. Strong buy, 35% discount. So they're growing nicely. Just be aware, like Google Cloud's growing at this rate, and I think their revenue is 20-30 billion. Microsoft, their cloud business is like nearly 100 billion, and they're growing at 27%. And AWS is huge, like 120, 140 billion compared to this 8 billion. And they're growing at like 15, 20%. I'm a stockholder in those 3 companies I just named. Okay, so 18% still good. A little bit of a small number. Let's look at their gross margins, see what that looks like. Gross margin, 55%. Looks good. These guys have to buy computers, operate expensive data centers, and so this is understandable. Now, they are burning cash. They're burning a little bit of it. Let's take a look at their balance sheet. Now, with the rising stock price like that, they could always issue out some shares to create some cash. So they have plenty of cash, 2.29 billion. Yeah, these guys are fine. Their balance sheet can support them operating for 5-10 years. They just IPO'd, so they got money. So this is a really interesting business. Now, a lot of companies are getting into this, high performance computing cloud business. And you're going up against three big companies. AWS, Amazon, massive. Microsoft Azure, humongous. Google Cloud, staggering. It's like those are your 3 competitors. And then there's a bunch of smaller players. Like some of the Bitcoin miners have changed their businesses to actually do high performance computing as well. So this is a good idea. The stock's really flourished. I just think it's a little risky. I'm 56, so do I want to take a chance on this one? No, I'm good with Google Cloud. I'm good with Microsoft. I own Google, Microsoft, and Amazon. So I got plenty of cloud. And these guys are a hyperscaler. They're an AI full stack infrastructure. When you hear that and you hear the term hyperscaler, that's what they are. Infrastructure companies. Cloud, public cloud, infrastructure companies. That is what they are. It's a neat business, and they're in the right place, right time, right? Right now, the AI build out is humongous. Now, are these guys going to keep going up? Maybe. Wouldn't be surprised if they came back down, maybe down to $28 a share, $24 a share, and then they went back up. I think we're going to see volatility in these guys. The beta is 0.75, so it's not a 1. If you see beta of 1, that means a very consistent stock. These guys are probably going to see some volatility. I don't like buying stocks near their IPO. You can go, I mean, just about every stock goes down and then it comes back up. And every single stock, because the near term performance is always doesn't look good. Like I'm gonna look at Hood, because Hood's been rocking this year, right? Year to date, up 34%. Beautiful. 1 year, up 354. Beautiful. They IPO'd back here. And then it was like, oh my God, the stock really sold off, because early on in the history of a company, the financials will not look very good when the company will sell off. Then once the biggest business begins to mature, then boom, they take off. So will this company we're looking at, resemble Robinhood, or like 80% of the companies at IPO? Potentially. That's why I would stay away from it. I didn't buy Robinhood when it IPO'd. I didn't buy Coinbase when it IPO'd, but I now own it, and I'm glad I bought it. It IPO'd way up here. I bought it down here, and I am loving life because it's way up here. So that's my 2 cents on a company that's so young. And I don't think they're going to like blow the roof off. They just have too much competition from big players. This is not a new space. This is a very well covered space. Accelerated computing is not new. So that's my comment on that. Good luck with it, Michael Anthony. All right, so I got to run. I don't know if you noticed, but my wife knocked on my door. It's time to go. It's time to go. All right, so tomorrow we got more earnings. We're just like in the very beginning of earnings, man. We are going to be deep into it tomorrow again. Whew. I don't know too many of these companies. I don't think I own any companies reporting tomorrow. We got some old school businesses reporting tomorrow. And we got more on Thursday. This week's kind of like interesting, but next week's like, all right, now, put on your chin strap, because we're going to see some big companies and we're going to see the market really move. The week after that, keep your chin strap on, because we're going to see massive earnings like week after week. It's going to be like, geez, this market's moving, and it'll be really interesting. So everybody, thanks for tuning in. Thanks for all your support. Thanks for all your comments. Please become a member if you can, and we'd love to talk to you on weekends. And thank you, AP, for tuning in. And just consider it. And everybody have a good night. Good luck with your investments this week. We'll see you.